In today's episode, I'll talk about two interesting stories. In the first one, I'll talk about how India has finally cleared the air on bike taxis and why the real decision now rests with the states. And in the second story of the day, I'll talk about how Indian companies and households are quietly becoming more financially resilient and what that really means for our economy. Welcome to the Daily View show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Wednesday, the 9th of July. So let's start with the first story. See, like I said, India just took a very big step towards clearing the air around one of the most confusing questions in urban transport. And that is, are bike taxis legal or not? And if they are, where? Now, the central government has recently released a set of guidelines called the Motor Vehicle Aggregator Guidelines 2025 or MVAG 2025. Now, these guidelines officially recognize and allow bike taxis across all of India, at least from the center's point of view. Now, this is a massive move that could finally bring some level of clarity to such a sector that has operated in legal limbo of sorts for over a decade now. But to understand why all of this really matters, let's quickly take a step back and see how big a deal two-wheelers are in India in the first place. See, more than half of all Indian households own a two-wheeler, to give you some context, and that makes India the country with the largest number of two-wheelers in the entire world, even if you adjust for population, by the way. And that's largely because they are cheap, they are easy to navigate through traffic, and also in many cities, they are usually the fastest way to get around. And that is also obviously why bike taxis are such an attractive idea. They basically give people a quick and affordable alternative to sitting and getting bored in traffic. And at the same time, they also help people monetize all those idle two-wheelers that are sitting in their house. So basically, instead of just using your two-wheeler for personal rides, you could pretty much use it to earn money by moving passengers around. Now again, to the casual observer, bike taxis might not feel like big news. We already see them on the road, and many of us have probably also used services like Rapido at some point in time in our lives. But the truth is, this entire time, the business had been operating in a legal gray area. It existed, but it did not have full legal certainty, and that made everything very shaky. Now, this new MVAG 2025 guidelines are supposed to change exactly that. So let's understand what these new rules actually do. See, for the first time, the central government has clearly said that private motorcycles, which are the ones with white number plates and not the yellow commercial ones, can be used for bike taxi services. Now, that basically means that you do not need to buy a new commercial vehicle or need to go through expensive commercial registrations to become a bike taxi driver. Now, this is the exact model that companies like Rapido have been using, and it has now some formal backing. And along with this, these guidelines also ask aggregators like Rapido, Ola, Uber, etc. to ensure proper safety norms. That include things like GPS tracking, insurance coverage, driver training, background checks, and so on and so forth. Now, these safeguards are basically supposed to address concerns around security, which has been a long sticking point in this area. But all that said and done, there is a very big catch here. See, transport is a state subject in India, and that means that even if the center says that bike taxis are allowed, it is ultimately up to each and every state government to decide whether they want to actually permit them or not. The guidelines are just that. They are only guidelines. They cannot force states to implement anything whatsoever. They will only give states the legal tools and regulatory clarity that they need in case they want to go ahead. Now, this is a familiar problem, mind you. The battle over bike taxis is not at all new to any of us. It has played out in multiple states across several years, and it has gone through many strange twists in the story. Now, this story actually, mind you, begins in Goa back in the late 1970s. See, Goa had a very unique problem back then. Its roads were very narrow and winding and not really suited for buses as such. And cars, of course, were too expensive for the average person to buy. But again, tourism was booming and travelers definitely needed a quicker way to get around the city. And that is when locals came up with a creative idea, which was using motorcycles as taxis. Now, in 1981, Goa became the first and the only state to formally legalize bike taxis. Now, these taxis, which were driven by riders which were called pilots, became a part of Goa's culture as such. They wore yellow helmets, they knew all the shortcuts as such, and they were almost as iconic as the beaches themselves. And for many, many decades, this remained to be a Goa-only story. No other state really followed their lead. But that said, in 2004, the central government tried to formalize the setup by allowing motorcycles to be legally considered as transport vehicles. Now, that basically meant that they could, at least in theory, be used to carry passengers for money. But in practice, it did not really take off as well. It was not until 2015 that Haryana became the second ever state to allow bike taxis. Now, interestingly, it was not the government that gave the ideal real momentum, it was actually startups over here. In 2015, Rapido launched as a bike taxi aggregator and took the Uber-Ola model and applied it to two-wheelers almost as it is. And very soon, other companies joined into the fray as well. Today, Rapido controls more than half of the bike taxi market in India, but there was a fundamental problem to all of this. India's Motor Vehicles Act was written back in 1988, which was very, very long back before the idea of app-based taxis even existed in the first place. So obviously, it only had rules for traditional taxis, which were expected to be four-wheelers with yellow number plates. So if somebody wanted to become a taxi driver, they had to buy a separate commercial vehicle and get ride permits for it. But again, Rapido's entire business model was sort of built around using personal bikes with white number plates to offer rides. Now the question is, was this even legal? The funny part is, nobody really knew. In 2016, the center passed the responsibility to states and asked them to decide their own rules. But again, this only created more and more amount of confusion. Some states said yes, some states said no, and many of them just kept changing their mind. Delhi, for instance, allowed bike taxis in 2016, banned them soon after, launched pilot projects, and then banned them once again. Maharashtra did something similar as well. There was basically no consistency, no predictability, and no clear legal position whatsoever. And over time, this all sort of became like a patchwork. States like Haryana, West Bengal, Uttar Pradesh, and Chhattisgarh welcomed bike taxis and issued rules, but other states, especially states like Karnataka, Tamil Nadu, and Madhya Pradesh, either completely banned them outright or they made operations so difficult that companies could not really function over there. Now, one big reason for this resistance was pressure from auto rickshaw unions. The thing is, bike taxis were cheaper, faster, and far less regulated, and that made them a real threat to the livelihoods of lakhs of auto rickshaw drivers, especially in cities where short-haul transport is a very big market. Now, auto unions naturally pushed back very hard. Let's take Maharashtra for an example. Union leaders over there argued that bike taxis would make life unbearable of sorts for auto rickshaw drivers who already had to follow strict compliance rules, pay higher taxes, and also bear the cost of commercial vehicle registrations. So if bike taxis could enter the market with no such burdens, it would obviously be an unfair playing field for them. And this particular pushback became particularly intense in Karnataka. In 2021, the state introduced the policy allowing electric bike taxis. But again, Bangalore's powerful auto rickshaw unions were not at all happy with this. They organized protests, clashed with bike taxi operators, and eventually forced the government to roll back the policy in March 2024. And things here escalated very quickly as well. In April 2025, the Karnataka High Court stepped in and ruled that without a proper legal framework, bike taxis could not be allowed. So the state banned them almost entirely, and the impact, mind you, was pretty brutal. Over 1 lakh bike taxi drivers lost their source of income pretty much overnight, and the city also felt the absence immediately. Traffic in Bangalore got 18% worse in just about 1 week. Auto fares obviously spiked, and regular commuters who had depended on these bike taxis were sort of left without any alternative whatsoever. And this chaos, especially what happened in Karnataka, finally forced the central government to act here. And that is why on 1st July 2025, the MVAG 2025 was released. Now, this clearly states that bike taxis, including private motorcycles, are allowed to operate through aggregator platforms, but provided they meet the safety and operational conditions that are laid out. Now, see, from a policy standpoint, this is the clearest message that the center has ever given in support of bike taxis. It tells the state very clearly that the government is comfortable with this model. And it also gives companies like Rapido the legal clarity that they have always been asking for all of these years. And for the first time in almost ever, there has been a legal framework that allows any Indian with a motorcycle and a smartphone to sort of earn money legally as a bike taxi driver. But that said, the larger question still remains, will states follow through? That is a part nobody knows for sure yet. The guidelines do not force state to comply, like I said, they just suggest that states may allow private bike taxis. So every state will still have to decide for itself whether or not they would want to permit them and also on what terms. Now for states, this will not be an easy call. On one hand, the benefits are fairly obvious. Bike taxis generate employment, they ease congestion on the roads, reduce commute times, and they can even increase state revenues through fees and licensing. But that said, on the other hand, there is a real political risk. Auto unions have genuine fears, and the government cannot really afford to ignore them either. So the success of the MVAG 2025 would really depend almost entirely on how well states are able to balance these competing interests, because in that very balance could possibly lie the future of a sector that could soon be worth multiple billion dollars. That brings me to the end of the first story of the day. On that note, let's move on and talk about the second story. See, every 6 months, the Reserve Bank of India releases a very dense and data-heavy document which is called the Financial Stability Report. Now, for most people like you and I, it sort of flies under the radar, and that is because it is too long, it is too technical, and it is completely filled with charts. But that said, buried inside all of that detail is sort of a gold mine of insight. So if you look closely, you can understand something that is very fundamental: how strong or fragile the Indian economy really is. Not just in abstract terms, mind you, but in terms of the two most important players who drive our economy, which is businesses and families. So that said, instead of just summarizing the report, which also an AI can do, let's take a little bit of a different approach here. Let's take a look at the two big questions that matter to all of us. First, how healthy are Indian companies right now? And second, are Indian households handling their money well, or are they getting buried under debt? Sales growth has definitely slowed down, and companies reported year-over-year sales growth of just 7.1%, which by any stretch of imagination is only moderate. But what's impressive is that their profitability has not really taken a big hit here. In fact, they've actually managed to maintain solid operating profit margins of 16.3%, which is considered pretty strong by every standard, especially in a tough global environment. Now anyway, let's go a little bit deeper here. The real strength of a company is not just in how much profit it makes really, it is in how well it can handle its debt. And on that particular front, Indian companies seem to be looking very, very healthy. The RBI tracks a metric that is called the interest coverage ratio, which basically tells you how easily a company can pay off the interest on its loans using its own earnings. And of course, the higher that number, the better it is. Now, across the board, this number has been fairly strong. For manufacturing firms, profits are enough to pay off their interest costs almost 9 times over. And in the services sector, it's a slight bit lower, but it is still fairly healthy at about 2.1 times. And in the field of IT, it is off the charts. Companies in this space can cover their interest payments 44 times over. Now that's just not stable, that's extremely resilient. Now you might assume that this is happening because borrowing costs are low, but interestingly, that's not really the case anymore. Since March 2022, average lending rates for Indian firms have actually gone up by 1.62 percentage points. So this strength is actually coming despite higher interest rates, not because of lower ones. Anyway, there's another important indicator that's called the debt service ratio. Now this one looks at how much of a company's income goes towards repaying its own loans. The lower this number is, the more breathing room a company has. Now the data this time around shows that Indian firms are now spending less on debt servicing than they have on an average in the past. In fact, their debt service ratio is currently 1 percentage point lower than its historic average. And mind you, it's not just that they are managing well, they are also being cautious. On average, companies are sitting on cash buffers that amount to nearly 30% of their total financial liabilities. Now that means they have a decent pile of cash to fall back on if things happen to go south. Now when you compare India to other countries here, this particular difference becomes even clearer. The corporate debt to GDP ratio in India is about 51.1%. To give you some context here, China's ratio is over 160%, Japan and the Eurozone are both at over 100%. So India is comfortably below these levels, which means that Indian firms are not overly dependent on borrowed money, and that gives them a lot more stability in general. Now, of course, it's not all perfect. The RBI does warn that the current global environment, which is full of protectionist policies and trade-related tensions, could eventually put pressure on company profits. In fact, analysts have already started trimming their profit estimates for several sectors now. But that said, overall, Indian corporates enter the second half of 2025 in a fairly strong position with clean balance sheets, manageable debt, and enough cash to stay afloat even in rough times. Anyway, now let's move on and turn to the second half of the story, which is the part that concerns people like you and me a little more directly. And that is what is happening with household debt in India. Now, at first look, I know this is something that might look a little bit alarming. See, as of December 2024, India's household debt was at around 41.9% of our GDP. I know that sounds like a very big number, but let me very quickly put it into some context for you. See, the average for emerging market economies is around 46%. 5.6% right now. So actually speaking, India is still fairly below that average number. But still, the number is rising, and that raises a very fair question, which is, are Indian households taking on too much debt, or is something else going on entirely? Now, interestingly, what the data shows us is pretty reassuring. The increase in household debt is not because people are borrowing recklessly, it's actually because more Indians are getting access to credit for the very first time ever. Now, this expansion of formal credit, especially to borrowers who were previously excluded, is a fairly positive sign of financial inclusion in our country. And to give you a clearer picture of this, let's look at the numbers. See, in March 2023, the average individual borrower had a debt of around 3.9 lakh rupees. And by March 2025, this had grown to around 4.8 lakh rupees. But crucially, most of this debt is actually being taken by borrowers who are rated prime or even better, which in other words means that people who have strong credit histories. Now, these borrowers account for nearly 70% of the total household debt by value. So while more people are taking on loans for sure, the good news is that the bulk of it is actually going to those who are more likely to repay it back. But that said, of course, not everything is smooth. Some stress points do exist, particularly in lower rated borrowers and in housing loans. To give you an example, delinquency levels, which by the way are the borrowers who fall behind on repayments, are still higher for subprime customers. But even these levels have come down very sharply from the pandemic times. The gross NPA or non-performing asset ratio for subprime housing loans, which had touched 16% during COVID, has now dropped to 10.1%. And for high loan-to-value loans, which is where someone borrows a large amount with very little of their own money in picture, the default rate has fallen to just 3.3%. But that said, still, the stress in housing loans has not fully gone away, obviously. One big worrying sign is that more than about a third of the new housing loans in March 2025 went to existing borrowers who are people who already had a loan and they took another top-up one. Also, the proportion of housing loans where borrowers put in less than 30% of their own equity has risen to more than 23% now. That suggests that some people are finding it hard to repay their home loans and they are rolling over their debt rather than paying it off. Now, it's not a crisis yet, of course, but it is something worth tracking for sure. The biggest red flag, though, is coming from the microfinance space, which is small loans given to low-income households, usually in rural areas of our country. Now, over here, the percentage of stressed loans, which are those which are overdue by 31 to 180 days, has jumped from 4.3% in September 2024 to 6.2% in March 2025. Interestingly, this is happening even as the number of borrowers with loans from 3 or more lenders is going down. So the problem is not just over borrowing, it might reflect deeper economic stress in certain pockets of communities. So that said, with all of this information, the big question is, should people like you and I be worried? The answer is not necessarily. See, the overall picture suggests that household debt is rising, of course, but not recklessly. Most of the growth is coming from responsible borrowing by credit-worthy people. The pockets of stress are real, but they are localized and they are not widespread as such. But that said, there is one more angle that we need to look at, and this one might be the most important one really. See, Indian families are suddenly now changing the way they are building wealth. Financial savings among households have grown significantly in the last year. Around 31% of that particular growth came from rising asset prices like stock market gains, etc. The remaining 69% or so came from actual savings. That means Indians are not at large at least relying on luck or market rallies, they are actually actively saving more and more amount of money. But despite that, the real shift is in how they are saving that money. If you looked at household financial wealth in March 2019, almost about half of it, which is about 46.3%, was parked in bank deposits. About 29% was in insurance and pension products, and equity and investment funds made up just about 15-16%. Currency holdings stood at 8.6% and only 0.8% was in debt securities. But if you fast forward to March 2024, this has changed dramatically. The share of deposits and insurance remains high at nearly 70% of total financial wealth, but equity and investment fund allocations have jumped to 22.4%. That, mind you, is a 7 percentage point rise in just 5 years. And it shows that Indian households are becoming more and more confident in market-linked investments. Also, don't get me wrong, they have not stopped being conservative altogether. Deposits still make up about 40.6% of financial assets, and insurance and pension fund allocations have pretty much held steady at around 28-29%. But families are adding market investments on top of their traditional safety nets. They are not completely replacing safe assets like I mentioned, they are pretty much only diversifying now. Cash holdings, on the other hand, have declined slightly from about 8.6% to 7.6%, which basically suggests that people are putting putting their money to work instead of just letting it sit idle. And that shift has wider consequences as well. For the first time, domestic institutional investors like mutual fund, insurance firms, etc., now hold a bigger share of Indian listed companies than foreign investors. DIIs, or domestic institutional investors, own about 18.1% of NSE listed companies, and foreign portfolio investors, or FPIs, who for a very long time dominated our markets, now just hold 17.5%. You might be questioning what is really driving this transformation. Now, a few things stand out here. Investing has become much easier thanks to digital platforms and mobile apps. Financial awareness is spreading. Younger Indians who have seen good returns from stock markets over the last couple of decades or so are now suddenly a little more comfortable with market risk than previous generations. And of course, with deposit interest rates falling to beat inflation, people are also now realizing that if they want real returns, they will need to look beyond fixed deposits. This growing domestic participation is very quietly and subtly making our markets a lot more resilient. Basically, whenever there is a market shock or foreign investors suddenly pull out their money, it is the Indian investors who usually end up providing stability by buying the dip and holding through the storm. But that was not the case about a decade ago. But of course, there was a trade-off for this. With more money in the markets, family wealth is now a lot more exposed to ups and downs. A stock market crash no longer affects just HNIs or big traders, it affects lakhs of regular households as well. Volatility is no longer abstract, it also becomes a personal concept now. So anyway, with all of this information overload, the question is, where does this all leave us? See, corporate India is entering the second half of 2025 with a lot of strength, as it looks like it. There are clean books, there is manageable debt, and there is solid cash positions which make them well prepared for external shocks. Households, on the other hand, are walking a finer line. Debt is growing, of course, but in largely responsible ways. And families are also learning to grow their money, not just store it, which is moving from savings to investments, from safety to growth. So what we're seeing is a financial system that is maturing. It, of course, is still fairly cautious and still very grounded, but it is slowly becoming more and more open and more confident and also more connected to the market. That, of course, comes with both opportunity and risk, but for now, let's think it's a good thing for us. That brings me to the end of the two stories of the day. On that note, let's move on to the final section and talk about the quick news headlines. The first update for the day is what we had covered when the global sensational weight loss drugs first came to India, and now we have a small update on that. See, the demand for weight loss drugs in India has now surged, with Eli Lilly's Mounjaro doubling June sales to nearly 260 crore rupees and Novo Nordisk's newly launched Wegovy entering the market. Rising obesity and diabetes are fueling a five-fold growth in India's obesity drug market since 2021, which is turning it into a key battleground for global pharmaceutical giants. Second, recently we had looked at the hotel business and what their long-term plans look like. Now, another hotel company has come out with a new plan to expand, and it's interesting for us to know. See, at its AGM, IHCL chairman announced a nearly 6,000 crore rupee investment over 5 years to double the company's portfolio to 700 hotels and 70,000 rooms by FY 2030. Now, this expansion will include strategic acquisitions of boutique hotel chains like Tree of Life and a shift to a 50-50 mix of owned and managed properties. For the third update, we write about hospitality chains every now and then when their results come out every quarter. Now, a recent announcement might shake up how our next story will look next time around. See, Aster DM Healthcare plans to overtake Apollo Hospitals as India's top hospital chain by adding 3,300 beds and expanding into smaller cities like Indore and Bhubaneswar. Following its merger with Blackstone's Quality Care India, Aster aims to boost margins and scale up to 13,600 beds within 5 years. For the fourth one, let's talk about Jane Street. Now, of course, every single publication at that time had covered it last week, and we were no exception to it. But there is a small update to it. Now, Jane Street is actually pushing back against SEBI after being barred and told to return over 517 million US dollars, where they were accused of manipulating bank stock options. The firm insisted that its trades followed standard arbitrage practices, and it says that it adjusted strategies when exchanges voiced concerns. For the fifth and the final one for the day, let's talk about a story that we just covered yesterday, which was Pakistan's solar revolution. Now, on that story, we got some comments from people telling us how something similar is happening in Kerala. Let's understand what's quickly happening there. The new draft power rules in Kerala are in discussion, and they are facing backlash because they propose changes to net metering policies that would reduce the financial benefits for rooftop solar users. Critics are arguing that these changes would favor large power producers over individual solar solar panel owners, which could potentially discourage small-scale renewable energy adoption. That's all the news and stories I have for you today. I hope you enjoyed this episode. This is your host Anurag Bansal signing off. I'll see you in the next one. Take care and have a great day. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.